On February 19th, 2026, a fund run by one of the world's largest asset managers absolutely froze. Investors wanted their money back. The money wasn't there. Now, that sentence, the money wasn't there, is doing a lot of work right now because the money was there. It's just that the money was also somewhere else, lent to other people in the form of debt to software companies that are currently being eaten alive right now by artificial intelligence. So technically, the money does exist, in the same way your mortgage technically exists, somewhere in between the bank and your house and a spreadsheet and a dream. The fund froze on February 19th, and by late March, several more had followed. Mohamed El-Erian, one of the most respected investors on the planet, looked at all of this and posted one question on X. Is this a canary in a coal mine?
About private credit because stress is building in the space. Outflows are accelerating. Sentiment's negative. Blue Owl Capital is now limiting withdrawals to 5% after a surge in redemption requests. And investors are looking to pull more than $5.4 billion from two of its private credit funds. I mean, the pressure's mounting on the sector. There's AI-driven concerns. There's broader volatility, Mohamed. What do you make of this true shakeup in the private credit space right now? And are you concerned?
I'm worried about the firms themselves. Blue Owl, for example, the numbers you've mentioned, one fund got redemption requests that were equal to 41% of the fund. That's enormous. They will only meet 5%, which will make investors even more nervous. So there is a liquidity squeeze going on in...
Like August 2007. He was referring, of course, to the month before everything broke the last time. Welcome to the video that absolutely nobody asked for and everyone is about to need.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
It was the start of things to come. Recession was round the corner, thousands queuing to save their savings.
This market is as volatile as you'll ever see.
Traders say this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast.
Hello, my financially curious, quietly terrified people of the internet. Today we're talking about private credit. A $2.5 trillion industry that barely existed before 2010. And what happens when artificial intelligence, AI, decides to eat the companies that the industry was actually built to fund? And I know what you're thinking. Private credit, that sounds boring. That sounds like something a man in a very expensive suit explains to other men in equally as expensive ties, while I pay 17% APR on my credit card and 29% on my overdraft. You are correct. It does sound like that. And I apologize for absolutely nothing, because in approximately 12 minutes, you will understand why Jerome Powell, the chairman of the Federal Reserve, stood in front of a Harvard economics class and said, and I quote, "It will not end well if we don't do something fairly soon." The chairman of the Federal Reserve said it will not end well. 3 acts. Here we go.
Billion, because of one numbskull that sits here. I don't see enough reason to cut the rates now. And
okay, so private credit. Let's start there. Let's start here. After the 2008 financial crisis, regulators looked at banks and they said something. You need more capital. Be more careful, be more prudent, stop lending to every slightly risky company out there, everyone that walked through the door with a PowerPoint and a dream. Stop lending to all of them. And the bank said, okay, fine, you bailed us out, you gave us billions in taxpayers' money, we're not going to jail, but it's fine, we'll be more careful. And then a gap appeared. Nature abhors a vacuum, but central bankers and Wall Street bankers abhor it even more. So between companies that needed loans and banks that wouldn't give it to them, there was a gap. And into that gap, like every expensive weed grown through every expensive pavement, stepped the bankers, stepped the asset managers. Blackstone, KKR, Apollo, Blue Owl Capital. You might have heard of some of these names. So these firms, they raised billions, trillions from pension funds, insurance companies, sovereign wealth funds, wealthy individuals, and they lent that money at high interest rates to companies being bought and restructured through private equity deals. They're not public markets. They're not on the stock market. They're not stock listed on the exchange. They're just direct loans, private agreements, high interest rate, high yields, and a gentleman's understanding that everyone is going to be fine. The industry went from essentially nothing in 2010 to $2.5 trillion by 2026. $2.5 trillion built in 15 years on the foundation of one basic, flawed assumption: that the companies receiving these loans would keep generating revenue. But they might not, right? Now, to understand why this is a problem, other than the obvious, you need to understand the specific companies that private credit loved to back and why this could lead to the next financial crisis. They love to lend to software companies because software companies are exactly the kind of business a private credit fund dreams about. Recurring revenue, big growth, subscription models, sticky customers who would rather pay the annual license fee than endure the psychic cost of, migrating to another platform. Predictable cash flows, high margins, high returns. Essentially, the perfect borrower. The kind of borrower you would absolutely lend at a premium interest rate because you are confident they will pay you back. And then AI happened, essentially. And AI agents, software that can do the work that software company customers were paying humans to do inside those software tools, they began absorbing the revenues that those companies depended on. Research from Citrini. Now, this was a huge bomb. It laid it out in an article that went viral and led to double-digit stock price declines in these companies. The cascade they described went like this. AI renders large swathes of work redundant. Software company revenues are going to collapse, unemployment is going to rise, consumer demand is going to fall, and by 2028, the financial system is, as in 2008, on the brink again. They called it a risk map, very politely. Not a doomer fantasy, but a risk map. The difference is very important. A doomer fantasy is something you dismiss. A risk map is something you ardently and assiduously prepare for. Now, what makes private credit structurally different from a normal bank loan is the bit that makes it unpleasant, particularly unpleasant when things go wrong. Here's the asymmetry. In private equity, where the firm actually owns a stake in the company, if the company does brilliantly, the investor makes a spectacular return. But if the company collapses, the private equity investor takes the first hit and absorbs the loss. Makes sense, right? So fast forward to private credit. The firm just lends the money in private credit. The investor gets a fixed interest rate. That's it. That's the upside. A fixed rate, whether the company becomes the next Google or barely treads water. You get your interest payments and you get nothing more. But what happens, the smart ones out there of you are asking, what happens if things go wrong? Well, you lose everything. Absolutely everything. All the downside, none of the upside, which is fine, in theory, when the loans are performing, obviously. But right now, in the world where AI is eating the software sector, where Jack Dorsey just laid off thousands of Block employees, thousands of employees, not because the company was failing, but because AI could do their jobs better. The question of whether those loans keep performing is not a rhetorical or an academic one anymore. That is the question. It's the only question that actually matters. Now, just to really drive this home for the non-believers, for the acolytes who are yet to be acolytes, because I want you to feel the full texture of this situation, the full tapestry of how messed up it all is. Building AI infrastructure is not cheap. We're talking about a startup in a garage. No, we're definitely not talking about that. We're talking about data centers that cost tens of billions of dollars and trillions of dollars globally. Meta's data center, $30 billion, financed partly through debt from Blue Owl. We're going to find out more about them later. So in 2 years, just 2 years, from 166 to 625 billion, that's how much borrowing for AI centers has grown by. We're talking about hockey sticks. In financial history, when we talk about hockey sticks, we mean straight up and to the right. Huge borrowing, huge changes. There was an argument from a famous guy called Michael Burry. You might know him. He's the guy who made all this money by predicting the US housing collapse. He argued that firms like Microsoft, Oracle, and Meta, they're likely never going to recoup their investments in these data centers. His question was, which I'm going to write down on a wall somewhere because I think it's so profound, is it is consuming all of your cash flow. You are borrowing, you are financing in ways you never have because it scales. But if it scales, then when does it end? When does it all end? And that's the main question. This is where everything cracks. Because in February 19th, 2026, Blue Owl Capital, one of the largest private equity, private credit asset managers in the world, it froze a fund. And it froze the fund that lended to software companies. Too many investors wanted their money back, those pesky investors asking for their money back. They wanted it back at the same time, more than the fund could actually pay out, which begs the question, the gap between the money that they've taken and the money that they've lent out, that seems problematic to me. So instead of being honorable, they just froze the fund. Now, to be honest, most funds cap redemptions at 5%. Of invested capital per quarter. First come, first served basis. This is a mechanism designed to prevent runs on their entities, like a bank run, to stop the panic from feeding on itself. And in the first quarter of 2026, multiple funds reported that withdrawal requests surged past this cap simultaneously. Multiple funds simultaneously. Billions of dollars. Is this a canary in a coal mine moment similar to 2007, like Mohamed El-Erian has said? Because remember, in August 2007, that was when BNP Paribas froze 3 of its investment funds because it could no longer reliably value what was inside of them. It was the moment the 2008 financial crisis began, 18 months before Lehman Brothers. Remember, it started way before it. Most people think 2008 started in 2008, but it actually started in 2007. Very quietly, when a French bank froze some funds and the world didn't quite notice that they couldn't price the risk anymore. And the answer right now is we also don't know. But the question is being asked by serious people this time. And serious people asking the question seriously in itself is significant. Okay, now, I want to introduce another person to you. I want to introduce a man called Jamie Dimon. You may know him. You already might know Jamie Dimon. He's a maverick of Wall Street. He's a CEO of JP Morgan. He is, depending on your perspective, either the most important banker in the world or a symptom of everything wrong with it, essentially. Possibly both simultaneously, who knows? But in his annual letter to shareholders, a document taken seriously by the kind of people who take annual shareholder letters seriously, he wrote, I do believe that we have a credit cycle, which will happen one day. Losses on all the leverage earnings will be massive, and this will affect credit standards and modestly weakly across the board, which essentially means we're doomed. In a separate interview with another magazine, he said, when you see one cockroach, there are probably more cockroaches. So let me translate that CEO speak the best way I can possibly do so. Jamie Dimon is basically saying the Blue Owl freeze, the redemption freeze on all of your money, is not an isolated incident. It's a signal. And signals in financial markets precede events. He didn't use the word crisis. He chose the word cockroach. And in my personal opinion, a cockroach is much worse. Now, again, to another man, we'll fast forward. Another thing, Jerome Powell, the chair of the Federal Reserve, in late March, he also said that there's a problem. He did not say private credit. He did not say AI. He said US government debt. He did this in front of a Harvard economics audience. Now, we know that US national debt is 39 trillion, 125% of GDP, more than double what it was in 2007 when it was 60% of GDP. And Powell said, and I want you to really hear this, it will not end well if we don't do something and we don't do it fairly soon. The chairman of the Federal Reserve, the man whose literal job is to maintain confidence in the United States financial system, saying this will not end well. He also said something along the lines of, and I'm paraphrasing, federal government debt is growing so fast, it's growing faster than the economy. And that is the definition of unsustainable. The definition of unsustainable. Now, I guess this is fine, completely fine. Everything is fine. Let's just move on from all of these mavericks of Wall Street and mavericks of government explicitly warning us that this is not okay. Now, the issue is this. The speed of the next crisis is probably going to be unlike anything we've ever seen before. Banks are now using AI to manage treasury functions and liquidity management. AI systems are assessing shocks and triggering responses in milliseconds. If a stress event occurs, a wave of redemption requests, a cascade of loan markdowns, the AI systems at financial institutions will respond faster than any human oversight can track. The next crisis happens much faster. Meanwhile, the central banks and regulators will still be calling people and meeting people. So they will be much slower. And generals always fight the last war. The next financial crisis, whenever it comes, whatever form it takes, it will not announce itself diplomatically or politely. It will not arrive with a warning label and a countdown timer. It will arrive the way August 2007 arrived, as a quiet freeze at a fund that most people have never heard of, reported in a financial press article most people don't read or have access to because of a paywall, and dismissed by most experts who said the phrase, "This time is different," which is, as one famous book title reminds us, the most expensive phrase in the history of economics and finance. Now, the question is whether you're paying attention before it matters, because the people who were prepared in 2008 were not the smartest people in the room. They were just the ones who read August 2007.